Good afternoon and welcome back here to the Atlantic Council's studio at the headquarters of the International Monetary Fund for the IMF World Bank Spring Meetings. We're discussing monetary policy and its discontents, and I'm welcoming today for that discussion Themba Yumi. Themba Yumi had a long career at the IMF. He's been an economist in various country teams. He's been writing the World Economic Outlook some time ago and was head of that division. And then he spent a considerable time at the Strategy, Policy and Review Department, where we both overlapped also for some time. Tam has written a book on the global financial crisis called Unfinished Business back in 2015, right? That's still, I would say, a bestseller for many who are interested in what really happened back then. And you're now also a visiting scholar at King's College in London. We're talking about monetary policy and its discontents. So the initiation for that discussion was a look back at what happened really in 2021 when the inflation shock surprised many central banks, but not only central banks, also academics, institutions like the IMF. Nobody really kind of figured out what was going to happen. And the question is, in a sense, why did that happen? Why was it not detected? And why did central banks not react earlier? And actually, I should say, why did advanced economy central banks not react earlier to the shocks? Because many emerging markets had already seen something coming and they did actually take timely action. So Tam, in your view, what do you think what happened? What really explained the inflation dynamics and why the delayed response of monetary policy?
Right, well, let's start at the beginning in two ways. The first is, why are we talking about it today? Why are we talking about inflation? If you go back, Alan Greenspan had a very good description of inflation, and he said, you're in, as a central bank, you're a success if inflation is low enough where people don't think about it. And on that level, clearly we're in a different world than we were a few years ago. So what happened? Well, it wasn't that central banks didn't anticipate some inflation from COVID, but they underestimated both the size of the shock and its longevity and its persistence. And I think there are three reasons for this. The first is, at least in the advanced countries, since 2008, the major worry was always deflation or low inflation. They were always trying to get back to their targets. So in a sense, unlike earlier periods when the focus had been heavily on avoiding inflation, the focus for a very long time had been on avoiding low inflation and bringing the inflation back to target. So I think that their mindset wasn't really on inflationary risks. So I think that's one. I think a second thing which happened was the nature of the shocks. Firstly, obviously, there were some unexpected shocks like the invasion of Ukraine, which did things. But I think also the central banks underestimated the degree to which the shock involved supply chains and effects on the supply side as opposed to demand. I think a lot of central banks, along with a lot of other people, thought that the primary impact of COVID was going to be on demand, and that what you need to do is prop up demand. I think that the size of the shocks to the supply chain were a surprise, and I think that was because they underestimated the complexity of the modern trading system, where with just-in-time delivery, it was a very efficient system, but it wasn't a very robust system. So if one little bit in the whole equation gets knocked out, then you have problems elsewhere.
Yeah.
And I think the third thing, very briefly, is that they knew there was going to be a bit of inflation. So they were trying to think, well, how do we measure whether this is a problem or not? And the way they chose to do it was to look at inflation expectations, in particular in financial markets. But of course, the people in financial markets who were advising the traders were by and large using the same models that the central banks were. So in a sense, they were listening to themselves.
The economic community as a whole didn't quite have the right answer. But I mean, remembering at the time, there was a discussion between what they call team transitory, that was thinking, well, this thing is going to go away. And others who pointed out much more the fiscal stimulus that was in the pipeline and the discrepancy between demand and supply. How do you think that kind of played out. Inflation went up very sharply, but then it also came down quite sharply. So was Team Transitory right in a sense, or who in the end kind of you think won that debate?
I think it's a game of two halves. Clearly, Team Transitory lost the first half. Inflation went up much faster than expected. But on the other hand, Team is going to be high inflation for a long time, lost the second half in terms of the fact that inflation did come down. So in a sense, it was a semi-transitory shock, but one which is a lot more persistent and has had a lot more effects. And that's why it came back at the beginning, because there is now a narrative amongst some people saying, well, it was all basically just a transitory shock, but a bit longer than we expected. I think that's where the Greenspan definition of inflation comes in useful. That if inflation is now in everybody's heads as something to worry about, then central banks have a much more difficult task, and that's something which they need to think about.
Yeah, so I mean, inflation expectations still seem to be fairly well anchored, right?
Yeah.
So we're not talking here about a major expectations of higher inflation in the future. And I think that was probably also a reason why central banks, as you said, were a bit reluctant to tighten initially, because they thought expectations were well anchored, right? Now, kind of coming back to the actual underlying work that goes into decisions by central banks, there are very sophisticated models, of course, at work. But we now have a full-fledged discussion. For example, the Bank of Canada and the Bank of England have already criticized some of the models that they were using. And they say, well, they weren't really well suited to what happened. Now, do you share that assessment? Were the models not good enough? Are they missing major things? Or what kind of contributed to that analytical failure, in a sense, to anticipate this sharp rise?
Yeah, I think the models and the structures were designed for sort of normal times. And inevitably, I mean, any kind of model or any structure that you use is based on the past and sort of, looking at what happened in the past. And I think if you get very, very involved with models and using models too much, I mean, central banking is always about the lessons from the past, but also what's happening now and changing. And in a sense, I think the models that they were using were slightly too focused on the past, and they didn't spend enough time thinking, well, what exactly is the COVID shock? How exactly does it affect things? Now, it's very understandable. I mean, it's a once-in-a-century shock. But that, I think, was they relied more on the past maybe than what was happening now. And I think to that extent, now you have this discussion of sort of, flying by the stars or, charting by the stars.
Right.
And to some extent, that's an acknowledgement that they didn't do that earlier as much as they might have done.
Right. And the ECB, I think, came out with a speech by Philip Lane, I think, who more or less said, well, what happened was that the inflation was mainly driven by commodity price shocks and by food price shocks, even before the Russian invasion of Ukraine. And since we basically cannot predict these developments and the rest of the contributions to inflation from well-known factors was really small, there isn't really that much we could have done about it, is in essence what he says. Would you agree with that characterization?
Well, no. I think probably I would say yes, your formal models, it's very difficult to do those kind of things. We could discuss the types of models themselves and their structure. But I think the other thing is, going out and really talking to business people about what was happening in the supply chain, all of this kind of stuff would have really helped. As I say, it was a failure of sort of imagination, if you like, that, or at least a partial failure of imagination. I mean, it hasn't been too bad, as you say, inflation's coming back down, but there has been lasting effects, and there will be moving forward. And I think that, in a sense, they were too confident that this burst in inflation would be temporary, and they didn't realize that the impact on goods markets was going to be larger, in part, of course, also, because I think another thing which these models forgot was that you had this massive switch from consumption in services to consumption of goods.
Yeah.
So you not only have supply side, chain problems, but at the same time you have this enormous rise in demand for goods. So you end up with a lot of goods inflation. There wasn't much service inflation because nobody was going out and having. So you couldn't go out and watch it.
And of course, supply chain restrictions basically affected goods, right? Not services.
Yeah. Exactly. So, yes. So that is mainly supply chain restrictions were mainly about physical trade.
Yeah. But then shifting our attention maybe away from the advanced economies to those emerging markets, many of them, not all of them, of course, but they seem to have anticipated problems earlier, because when you look at monetary policy charts, generally there's a sooner rise in interest rates. And then they also were able, at the peak of inflation, which one should say in emerging markets, inflation also went up. But the central banks were more eager in anticipating it and probably prevent it worse. But they also could then lower rates again further before, for example, the Fed is still kind of stuck at the current level. So what do you think explains that alertness, that anticipation of inflation of emerging markets? Why were they kind of more alert to the fact that something was happening?
I think, the first point I made about the advanced countries was that they'd been fighting or worried about low inflation for a very long time. That was not true of the emerging markets. By and large, the emerging markets have always been much more worried about high inflation than low inflation. So in a sense, I think their policy antennae were much more attuned to the type of shock that we actually got. Whereas in the advanced countries, sort of inflation came as a bit of a shock. I think in the emerging markets it didn't, because that was the thing that they'd been worried about for a very long time. Now, obviously, you say emerging markets, this is a vast and varied group of countries. But nevertheless, I think as a general pattern, that's right, that they were still thinking about how to bring inflation down towards their targets by and large, or staying within the targets, but they were worried about upside surprises, not downside surprises, and therefore they were much more...
I guess they must have also been worried about capital flows.
Well, that's the other thing, which is that the thing I think that they were worried about was capital outflows. And if you were worried that during this time of incredible economic uncertainty, money would flow into safe assets, i.e. the US, basically, US Treasury bonds, and out of emerging markets, then you'd be much more prepared to raise interest rates. And I think that was another factor. I think coming back for a second to the major countries, I think also that the quantitative easing policy played some kind of role, and let me explain that. Obviously, the major central banks have bought really large amounts of bonds. And of course, if interest rates go up, bond prices go down. That's how it works. And so the fact they were holding all of these bonds and didn't particularly want to have the prices go down, it probably wasn't the major driving force, but it can't have been completely outside of the realm of their thinking, that owning all these things. And certainly I think the difficulties that we've seen with them getting out of this quantitative easing policy that they've got into suggests that there are problems with exit. And of course, they reacted to COVID by buying a lot more bonds. So they had an even bigger hoard of bonds sitting when they saw this. So part of it, I think, was that it wasn't convenient to assume that interest rates would have to go up.
Yeah. There's, of course, also the old debate, right? If you're more like a monetarist right now, you'd say, well, there was so much liquidity out there that it just needed a trigger to somehow get the inflation process going. And COVID and the supply shocks in a way were that trigger, and then you had that stronger than expected run up because of all the liquidity out there. I don't know. I mean, mainstream economists usually say that the quantitative theory of money and inflation is not working that well, but maybe that's among the things one should consider. What do you think?
Well, I think, it's strictly saying, oh, the money supply has gone up by 10%, therefore prices have gone up by 10%, even if you define what you meant by the money supply, where there are many different definitions, is probably not right. But the idea that there's a lot of liquidity sloshing around the system and something will happen either on the financial side or on the inflation side is very reasonable. I mean, you think about the run up to 2008, there was an awful lot of liquidity sloshing around the system, and in the end, you got financial problems. Because, if you've got a lot of liquidity, people need to lend it.
Yeah.
And they don't always lend it in sensible places. Now, I think, as you say, in part because the nature of the shock and the fact that it focused a lot on goods was the trigger for inflation. As you say, having that amount of liquidity, and as we've seen, the core banking system has not been immune from problems, admittedly relatively minor problems, but nevertheless there have been failures in the US banking system and the Swiss banking system. And so I think the idea that liquidity is something to worry about is a very reasonable one. And I think it goes through various channels.
Yeah. I mean, that goes, I think, into the question of how should one think forward? Obviously, if there's another situation, a pandemic or some other factor, a supply shock, as a central bank, one would like to be in a better position of anticipating that through the models. I mean, it's one thing flying by the seat of the pants, but you also want to have a better analytical basis for your decisions, of course, right? So in what sense do you think, in what direction should central banks go when they think about model improvements and the like? There's a lot of discussions out there. The American Economic Association had meetings where people were talking about L-shaped Phillips curves or other, the fiscal theory of inflation. We have liquidity issues. Is there a way to put this all together in the current flight of models, or does one need something completely different?
I think you can. I think there was a time in the 80s and the 90s when people thought they'd sort of found the way the economy worked. And so they had these big models which represented, had a Phillips curve, had inflation expectations, and all of that. I think confidence in that specific model is now going down. In part, as you say, nobody's even sure if the Phillips curve is really quite working.
Yeah.
So I think the answer to that is probably what, for example, some people such as the Bank of Canada are doing, which is a sort of suite of models. In other words, rather than relying on one thing and putting a lot of resources into one model of the world, at a time of heightened uncertainty and also, of course, heightened shocks. I mean, one of the complications with the traditional, what are called DSGE, neo-Keynesian models, is that they sort of assume that you know the long run and that everything else is short-term deviations from that. Well, that when you think about your own life, that's slightly odd. Do you think that the long run's certain and that the short run is uncertain? That's not the way I live my life, and I don't think it's the way that most people live their lives. So this sort of idea in these models that sort of the future was fixed and it was the short term which was the issue, I think is something which needs a bit of rethinking. Now, obviously, if you've got a forward-looking model, I mean, one of the great successes of economics has been sort of forward-looking models, then you do need to have something that you're heading towards. But I think it would be useful to be a bit more, a bit less doctrinaire about where you're headed.
Right. And I mean, one will probably not be able to capture fully reality by sticking it into models, right? I mean, I think the central bank world has seen huge improvements by having that analytical instrument, these analytical instruments at their disposal. But as we probably agree, this recent crisis has shown that you still need people to make actual decisions that may not be totally driven by the model results. In fact, you need a lot of judgment, right? Then the question is, I guess, how could one train central bankers? How could one foster their capability to improve decision making? What kind of qualities do you think are required for central bankers?
Well, I think there's a couple of things here. One of which is, is central banking an art or a science? Well, the answer is, I think, is a bit of both. I think there was a time when central bankers were sort of wanted to think that it was very scientific and sort of a bit like physics or whatever. Well, physics doesn't involve human beings who can change their mind and react in ways that you don't expect and all sorts of things. And it's a really complex system. So I think, as I was saying earlier, and as you were just saying, I think a bit more, people who look at the data on a very, very specific basis and what exactly is going on, in particular what's changing. As we said earlier, models tell you about the past, and they tell you about past relationships. Current changes are different. And I think at a time when technology is changing fast, geopolitics is changing fast, and we seem to be beset by many more significant shocks which aren't purely economic, as in that world, a bit more sort of looking at the data very hard is warranted. And indeed, as I was saying earlier, I think that that's actually what the central banks, when they say, we're being guided a lot more by the stars, data-driven, etc. That's sort of, I think, central banking shorthand for we're looking a lot harder at what's going on.
No, I'd like to get your thoughts on two aspects of that. First, maybe with an anecdote. You and I both remember Alan Greenspan because I think we were working together on the US team and he was governor before the global financial crisis. And he, of course, was known as a master of kind of deep diving into data that gave him some information about the US business cycle, right? And this very obscure knowledge about certain indicators like railway tables and the like, I think made him famous. Now, today he would probably have a much more difficult time because a lot of the information is online. There's a lot of data that's virtual. Lots of prices, goods are being sold and purchased on the internet. So is it more difficult these days to actually grasp the trends of an economy, do you think? And second, if it really should be more difficult because a lot of stuff is online and digital and there's no one single price for the same transaction within a day or two because everything changes all the time, should one employ, for example, artificial intelligence methods more systematically at central banks for trying to divulge the underlying trends behind the many data that are now available that one single human mind probably can't even grasp anymore? What do you think?
Well, I think you've brought up a very, very important issue, which is things do react faster because people have more information. But for central banks, okay, the economy is reacting fast, but also there is more information out there. So it's not clear which way that sends the art of central banking or the science of central banking. What it does mean, I think, is the central banks need to be very attuned to new sources of data, how they can pick this up. Nowadays, with the IT revolution, you don't need to compile huge amounts of data. It's striking how much, everybody still seems to stare at the CPI. And we know that sort of responses to these questionnaires are going down. Also, there are still delays. Whereas, presumably JP Morgan or whatever, credit card issuers have quite a lot of information, which is very short term. So I think that sort of part of the structure needs to be rethought. I think you can overdo it though, because some things react very fast. But in the end, consumers want a certain amount of certainty, just think about how people react when they're, when there's real-time pricing of cabs.
Mhm.
People get into or order an Uber and think, oh my God, that's
Yeah.
much more than I expected.
Yeah.
So I think there is an element in human nature that wants certainty. I mean, why do you have fixed prices in stores?
Right.
But that being said, I think the world's changing a lot faster,
Mm.
and I think IT is both the reason for that, but also part of the solution.
Yeah.
So,
I mean, I was struck, I mean, that's not a question, but simply to share that I was struck by an article that said meteorologists have used AI models to improve their capacity to analyze hurricanes and make hurricane forecasts. So being more specific about the strength and also the location of where they fall on land. And that, of course, has very concrete benefits for minimizing, not damage, but minimizing losses of life, among others. It would be great if some economists were to figure out how to make more sense of data to have better price forecasts, for example.
yes.
It's just something for the future, I guess. I'm sure there's some
Well, I
research
think it
going
is.
on already.
No, I think the great advantage about AI is, as you say, it can compile a lot of data
Yeah.
and improve the way that you look at things, and in a way that a human mind can't really take all of that data and.
Yeah.
Obviously the downside is a bit of a black box.
Yes.
So, so in the end it's sort of, well, how did you come to that conclusion? Well, because the machine told me that was the answer.
Even more a big box than a complex model.
Yes,
Yeah.
exactly. It makes the DSG model sort of simple.
That's right. Tim, in the 2 minutes or so that we have left,
Yeah.
just your assessment. The Fed has just hinted that they may not raise rates, lower rates anytime fast, whereas the ECB has made noises that they may. And what do you think? What does that do? Do you think they're going to follow up on those hints? And what does it mean for the exchange rate, for long-term interest rates and the like? What's your kind of look forward for, look ahead for monetary policy?
Well, certainly if you look at the market expectations of what's going to happen, there's been a significant change in the futures markets in both the expectations of what the Fed will do and what the ECB will do. And of course we've seen the consequence of that in terms of the fact that there'll be higher US rates and lower rates in Europe. We've seen the consequences in terms of an appreciation of the dollar. That in and of itself creates other waves. I think in particular, it's less of a concern for most advanced countries, which are pretty internal, and I think it's more of a worry for many emerging markets. And I think it's also going to be complicated for them because they probably don't want to raise rates. I said that they were worried about capital outflows rather than capital inflows.
Yeah.
I suspect at this point that calculus may have changed. And it does make you wonder sort of at what point you should start thinking about other policies, intervention, possibly even sort of some things on the capital market side. I think it does make you wonder at what point they should start seriously considering that.
Yeah.
And there, as we both know, the IMF now has a rather more flexible framework than they used to have to think about these issues. And I think it's worth thinking about what should be the appropriate responses. I'm sure people in the IMF are.
Right. So after passing, quote unquote, the inflation tests, emerging markets may be back in focus, basically.
Yes,
I think
so.
that's the takeaway. Right?
I think so.
Well, that was monetary policy and its discontents. Thanks for watching. If you're interested in more Atlantic Council conversations, please check out the website where we have everything listed that's been done so far. And we have one more day of coverage until everything closes down tomorrow. Thank you.